Well, Baring Asset Management believes that the outcome of the Eurozone debt crisis will be one of neglect from monetary policy in developed nations, coupled with a continuing series of inflation target misses. Well, joining me for more is Baring Asset Management's Toby Nangle, Director of the Multi-Asset Group. Thank you very much indeed for joining us today. If we can begin by just looking at the earnings that we've had recently. When we saw great European earnings, mostly when you dug down a little deeper, I'm thinking of Telefonica, the car makers, whatever, the strength was really coming from somewhere else, an emerging market. Is that how you see these markets going forward? Do you think that the stronger equities in Europe are actually going to be getting a lot of their earnings from elsewhere?
Well, increasingly, European equities and UK equities derive a growing proportion of their revenues from emerging markets where there are real volume growth. So that's a theme that comes through, and we can actually find that we can pick up for lower valuations in some cases, emerging growth in European and UK equity markets. Not always, but sometimes, and for specific stocks, that's certainly the case.
Now, what about European markets? Are there any generally where there is a little bit of value? Italy, I think, is one.
Well, within on the bond side, we certainly see that Italy has got fundamentals which are not fantastic, but
in comparison,
but are somewhat over discounted on the cheap side, if you like. There are structural problems with some of the other countries that are reflected in wide spreads that Italy doesn't share. And when we translate that onto equity side, we find the equity market's actually mirroring, in many cases, the views of the bond markets, or at least coming to the same conclusions. So from that basis, yeah, I mean, Italy could be a market that's quite interesting. But more generally, we're looking at European market as a whole is offering quite good value at this time.
And if you're looking at where investors should be placing their money, what about investing directly in emerging markets?
Well, emerging markets, we think, are a growth story of the future. Now, with that growth, we think will come a certain amount of volatility. There are more fragile institutions. There are great emerging market stories where we have secularly improving institutional governance structures and moving to inflationary targets or succeeding with those inflation targets. And in those situations, there are sometimes some great valuations to be had. But more overall, when you say where should investors be putting their money, I think it's really important to be thinking about this within a portfolio context. So thinking not only about the growth that comes through on emerging markets, but also combining that with some attractively priced insurance assets, if you like, such as Australian government bonds hedged, or indeed gold or agricultural commodities.
I wanted to talk to you a little bit about gold, because we've seen it coming back up a little bit recently. Historically, it's at very high levels. Where is it going to go from here?
Well, with any luck, as someone with a fair amount of gold in our asset allocation portfolios, with any luck, it'll actually do pretty much nothing, or indeed fall slightly. We are not buying gold with the view that it should double or triple, as some investors have said. Rather, we're thinking about it from a portfolio construction perspective. In some tail events, either inflationary or deflationary, and if the deflationary was combined with some further financial stresses, we feel that gold could be a great store of value and could have some great price performance. But that would really just sugar the pill of falling risk markets more generally, that sort of environment. So it's a very useful asset within portfolio construction. But if you were to ask me, where will the gold price be 1 month or 3 months from now, I have to say that I don't have a strong view.
Now, just to add before we go, agricultural equities, you mentioned them there. We've seen wheat prices rocket up. We're not expecting to see the kind of soaring numbers from 2007-8, are we?
Well, I think that if you look at the drivers of these strong performance on agricultural equities and strong performance from agricultural commodities, you can explain it due to harvest misses, bad weather conditions and the like. But we feel there's a greater, more structural story behind that, associated with weak central banking, if you like. Some of the sentiments espoused by Thomas Hoenig in the US, or Andrea Catherwood in the UK, I've got a certain amount of sympathy for. That monetary policy is very loose, and if that doesn't come through in asset prices, it might come through in food prices, in energy prices, and inflation more generally.
Thank you very much indeed.